Hello, everyone. Welcome back to Airlines Quest. Today, we're diving into some significant shifts happening in the aviation industry, particularly focused on the evolving relationship between European airlines and the Chinese market. We'll discuss intercontinental flight trends, the impact of geopolitics, and the financial stress facing European carriers. So, let's get started. Let's start with a positive note. Intercontinental flights between Europe and Asia are showing strong signs of recovery, nearly catching up to pre-COVID levels. However, there's a contrasting trend emerging. European airlines are quietly reducing flight frequencies to Greater China. This isn't just a minor adjustment, it reflects a deeper structural shift driven primarily by geopolitics. Since the Russian invasion of Ukraine began on February 22, 2022, European carriers have had to reroute flights to avoid Russian and Belarusian airspace, as well as most of Ukraine. Interestingly, Chinese airlines are not facing the same restrictions. Russian airspace remains open to them. This has given Chinese carriers a significant competitive edge, allowing for shorter flight times and reduced fuel costs. For instance, a flight from Guangzhou to London takes Chinese Southern Airlines about 9 hours and 58 minutes, while British Airways takes over 13 hours. With fuel costs making up about 25% of a flight's expenses, this difference is crucial for profitability. As we delve deeper, we see that European airlines are grappling with tight margins on flights to China, compounded by existing subsidies that Chinese airlines enjoy. These subsidies allow Chinese carriers to offer lower ticket prices, which is a challenge for European airlines already struggling with weak yields. In fact, projections indicate that the share of Chinese airlines flying to Europe could rise dramatically this winter, from 56% in 2019 to an astonishing 82%. Moreover, around 18 new routes from China to Europe are set to open, primarily operated by these subsidized Chinese carriers. But can we solely pin this situation on the geopolitical tensions stemming from the war? Not entirely. The groundwork for this shift was laid long before, with escalating tensions between the US and China influencing European perspectives. The COVID-19 pandemic acted as a wake-up call for Europe regarding its reliance on China, prompting a gradual de-risking strategy to diversify supply chains and reduce dependency. The result of these combined factors has been a significant drop in travel demand to China. While around 50 million visitors traveled to China globally in 2019, that number has plummeted to just 17 million so far this year. With China's economy facing its most significant slowdown in 45 years, outbound travel demand is waning. Interestingly, even Qantas, with its strong ties to China, suspended its Sydney to Shanghai route due to low demand, illustrating that this trend is not limited to European carriers. As we analyze the landscape, we see a clear trend. European carriers are gradually withdrawing from the Chinese market. British Airways has suspended its London-Beijing flights and cut London-Hong Kong services by 50%. Finnair has drastically reduced its Chinese flights from 42 per week to just 3, with 1 to Hong Kong. Other carriers like LOT Polish Airlines, Lufthansa, Qantas, SAS, and Virgin Atlantic have also suspended routes to China. Air France is even lobbying the French government to impose taxes on Chinese carriers to create a more level playing field. But so far, these efforts have not yielded results. Looking ahead, we must consider if this environment is the new normal. With the ongoing war in Ukraine and China's economic challenges, the dynamics in the aviation market could remain unstable. The political stance of China towards Russia will be pivotal in determining whether its aviation market experiences a prolonged period of isolation. One potential strategy for European airlines is to leverage partnerships with Chinese carriers. For instance, Lufthansa, while stepping back from direct routes, is relying on its joint venture with Air China to meet customer needs. Moreover, emerging markets in Asia, like India, Vietnam, Thailand, and Indonesia, are thriving, providing European airlines with opportunities to shift their focus and capacity away from China. Additionally, mature markets in Japan, Singapore, South Korea, and Taiwan are seeing a post-COVID rebound, which could further help European airlines rebalance their networks. What do you think? Will European airlines find new strategies to cope with the challenges posed by the Chinese market? Let us know your thoughts in the comments below. And don't forget to subscribe for more updates. Thank you.